while we were just here talking about the credit spreads, Rex, and what he's talking about is the trade simulator tool. And if I go to radioactivetrading.com, where we talk about the married put techniques we just mentioned and more, I go to resources and go into the trade simulator tool. Now, what this tool does is it allows me to sort of gauge what my expectations would be for a trading record, track record, or expectations for a trading plan moving forward based on a target return, loss limit, probability of win and losing, how much I'm starting off with, and of course, an investing per trade. So what did we first look at here when we came up and we had 10% target return, loss limit of 10, 50% probability? Well, this would kind of be what you'd expect, Rex, from a buy and hold, wouldn't it? I'm buying stocks, not using options. I'm going to set a 10% stop on the upside to profit. I'm going to put my loss limit at 10%. Most of us would probably use 7 or 8%, I know, but let's just assume we use 10%. And of course, 50-50 win-loss ratio. Some stocks are going to gain, some stocks are going to lose. Flip a coin 100 times. Heads we win, make 10%. Tails we lose, and lose 10%. Start off with $10,000 and allocate 50% to each trade. And of course, you see here, if we have more losers than winners, naturally, we might have what we think is a winning track record over time. But then, of course, we're almost down 40 or 50%. In this case, down to, about $6,000, down 40%. We end up with a losing track record long term. So Rex's question was, how would you enter information in the trade simulator tool when trying to analyze naked puts, where the probability of the option strategy staying above the strike? Would you use the option premium percent return as the expected profit? Yes. And what would you use as the maximum loss? Okay. So we saw some naked puts earlier, and we saw the naked put for Alice. And when we talk about a naked put, whether I'm going 1 week out, whether I'm going a month out, what your target return is expected to be when you're right, Rex, and you make the maximum return, let's say 1.5%. This assumes that I'm looking still for 75, 80% probability of the put expiring worthless, probably 4%, 5% out of the money. That's sort of a good range for 1.5% naked yield, 2, 3, maybe even 4 weeks out in time, 4 weeks or 3 weeks out in time. Now, when you lose, Rex, and we'll lose on covered calls, we'll lose on naked puts, we'll lose on bull puts. But when you lose, you usually have a trading plan in mind. Okay, so I sold a premium looking to get 1.5% on my naked yield. As the stock starts to turn and drops to within my 1% rule of my short put strike, think about what your average loss is when you close these positions, Rex, with your trading plan. Do you take an average of about a 5% loss on the money set aside, the cash secured amount, or is it closer to a 7% loss? Let's look at it this way. Let's follow William O'Neill's IBD guidelines that if the stock falls 7% from when you entered it, you'd likely exit the position. Might do the same approach with cash secured naked put. If the stock falls 7% from when you opened the put, even though it was out of the money, you're going to look to close the position. It's going the wrong way. You took in 1.5% premium, but as the stock starts to fall, you know this put is increasing in value. So maybe your loss is a little bit less than 7%. It's a little bit less than the stock. So we could go ahead and just put in a loss here of, let's put 6%. Okay. So buying it back to close for a loss, you're not considering rolling down. You're just looking at a hard heads we win, tails we lose, not consider rolling. Here we go. In this case, your probability. Well, I'd mentioned you might be looking for a probability of, say, 70 to 75%. I'm sorry. This is a probability of loss. So my probability of success, Rex, would be 73%. Let's reverse it. My probability of loss would be 27%. Okay? The 73 minus 100. And same thing. We'll start with $10,000, allocate 50 to each. Now you see here, even with a winning track record, 76% of the time, we're not getting ahead. Okay? And that's probably because we're a little bit too far out of the money there with that premium to be successful. We're probably going to need to be right about 82, 83% of the time. Let me see if I can get one in there. So we're running this as flipping a coin 100 times. 78 is still at a loss long term. Yeah, let me go ahead, just adjust this here. Let's take this down to 20 so I can get an 80. I think it's going to be 82%. Going to be the target. All right, 81 gets you essentially to break even. Okay, so even with, if you average 1.5% yield on the naked puts, and you're limiting your losses to 6% when it moves against you, which kind of makes sense, doesn't it? Considering what the cost basis would be, and if the stock fell, you're closing when the stock falls 7%, so you might take a total of 6 or 5.5% loss on the position. You need to be right on average 81% of the time. That's with a 50% allocation into 2 trades. I think 82, close, right? I mean, it's close to about a 6% profit there in that case, but you want much more than that. You probably want at least double that with the naked puts. So, of course, now we're probably going to have to go up to about 2.5, take more risk, less out of the money. Let's take a 7% loss. And let's go back to our 27% probability Rex. And there you go. See, now you're at 77% and you're starting to do it. But that's all dependent, knowing that you're going less out of the money for a higher return of 2.5% Rex in this case. And then, of course, here, controlling the losses to 7% as well. Okay, now, I wanted to bring this up here for another reason. We had just talked, but this is how I would do it, Rex. Your target return for what you expect on average to make the profits of your naked put positions. The loss limit, what would you expect the loss to be? Remember, think about it as owning a stock. You're putting up the full cash secured amount for the naked put, Rex. If you stop out your positions on average, you're taking a 5 or 6% loss of the monetary amount there, that would be your loss limit. And then the probability of loss, if you're right 75% of the time, the probability of loss is 25% of the time. But I wanted to come here for another reason. One, I wanted to show how important it is that on average in my bull put credit spreads, if I'm looking for a 15% return on my 2-week out spreads on average, 14.9, 15%, and I'm going to control my loss limit to 50%. That sounds high, but it's a leveraged spread trade. Remember, when the stock starts to move against you, I want to stop it at 50% loss limit that we had in that discussion there, sort of for Nick. That's one of my triggers. And I'm going to put my probability of loss at 15%. I'm looking for an 85% probability or higher. It's actually probably 13%, 87% success rate is what we're really at. Now, I'm going to change this, though, a little bit. And I'm going to say, let me start off with $10,000, but I'm only going to allocate 15% of that $10,000 into bull put credit spreads. Okay. And okay, so here you see, yeah, if I've got a 90% track record, that's fantastic. Money piles up really quickly. 81% success rate, still taking that initial $10,000 up to $13,785, $3,785 profit, almost double that at one point throughout the track record as well. Let's take these numbers. These look good. 37% return over 100 trades, 81% success rate. I'm still going to keep my 15% target profit, but I'm going to allow the loss to go up to 65%. With an 83% success rate, that's an ending amount that's half, a third of the profit I had with keeping the losses at 50% when they go against me. Okay, there's a good track record. I want to get back to 81, 83, 85, 81. I'm at a loss. Changing just that dial. Still targeting 15% return on the winners, but allowing the losses to go up to 65% of the max loss on the position. The money I allocated aside to the trade now gives me a losing track record. I am down 14%. And at one point, I was down 36%. This illustrates the importance of definitely controlling the risk on these vertical spreads to 50% of the maximum loss. But it also goes to Stephen S.'s question, where he says, I'm a new trial subscriber, so I'm working my way through the materials and webinars. What percentage do you allocate for each of your option strategies? I'm currently using 50% calendar spreads and 50% bull put spreads, and I'm afraid that is too bullish. Stephen, I am afraid that is too. Let me take, I know that you're probably using a lot more than $10,000 here, Stephen, but let me put 50% in. And I'm even going to keep the 50% loss ratio here. And we're going to go to 20. Okay? 71% success rate, allocating 50% into, let's say, bull put credit spreads. Winning track record, not enough. You're almost bankrupt. You had slight wins at one point, but something happened. And that's with controlling the losses on each spread to 50%, essentially. Let's get to 80s. Okay, so now you're looking pretty good if you're right, but you got to be right 85% of the time. 81%, you're still looking pretty good in this case. But let me give you an example. I have the slides here. I don't have the slides here, Stephen, so I'm going to write it out. We're going to take a look at a profit and loss chart, excuse me. Let's go back to Apple. Let's go to SPY. And here we go. I'm going to go to big charts. And I'm going to need to look at a custom range. Custom. Okay, here we go, folks. February 1st, 2018. February 15th, 2018. See if this will give it to me. I need more. I'm sorry, I need much more time. Let's go January 10th, January 15th to 215. There we go. That's better. Okay, so before I go any further, Stephen, let me answer your direct question. At any given time, somewhere between 45 to 55, let's just call it 50% of my capital allocated to options trading is in married puts. The limited risk married put approach in the radioactive trading techniques, buying stock, buying a put. So I'm guaranteed that I can't lose more than 4 or 5% on any position in an unexpected event. 10 to 15% will be bull puts, depending on market conditions. There's a certain thing that I look for there, but in general, 10 to 15s in bull puts, about 10 to maybe 15%, really it's about 10 to 12, a little bit less, is in diagonal spreads. Oh. And so then I might have about 4 or 5% sort of playing around with some fun in, this might also include a standard collar. I might have some standard collars in this 50% because they're more capital consuming. So 4 or 5% might be in something such as a long straddle or long strangle around earnings, essentially a lottery ticket. And then maybe 1 to 2% is going to be on puts on SPY. Sometimes it's 3%, or calls on the VIX. Okay, so mid-range 85%, and then another 10 to 15% is just in cash for adjustments. Stephen, is generally what I look for. So 10 or so into cash, 10 to 15% in cash. Why is this here? If I've got 50% of my portfolio in protected naked puts, why am I putting 1, 2, 3% into puts on SPY or calls on the VIX? Oh, and it's because of days like this. And there were 3 or 4 of them in 2018. There was a couple in 2019. We know there was one big one in 2020. There's actually one after that a couple of times. What is this? This is February 5th through 9th, Stephen, 2018, when the market was going very, very, very strong and had been for the past month and a half, essentially, after the bottom of that disastrous December in 2018. Market, everything was looking good. Volatility was extremely low. That's why the VIX and the calls in the VIX, excuse me, Stephen, were so attractive. And right about here, sorry, let me scroll down. I apologize, but I want to find the exact date. You can see it on the position here, but it's right there. Yep. This first day here was leading up to it a little bit. This first day here, February 5th, I had options expiring, 3 bull put credit spreads. I believe it was Texas Instruments, Netflix, and I always forget the last one. It's one that I was in before, and for some reason I can't mention it. It's in the bull put credit spread product that's coming out soon in a week or so. TXN, Netflix. I opened them back here. They're set to expire here. On this day, they were all at a profit, Stephen. Okay? Not a big profit. I collected 35 cents. I could close it for 20, so I'd make about 10 cents on it. In an instant, these three positions that I had went to a 50% loss. And oh yeah, I had two calendar spreads open. They went instantly to a 60% loss in an instant. I closed out all three of the bull puts here on that moment. I closed these diagonal spreads here on that moment, Stephen. Why? A day later, they were down 80%. 2 days later, they were 90%. Here at expiration, all were at essentially 100% loss. The diagonal spreads, even with time left, they were at 88 to 91% loss. You just mentioned to me that you're 50% into bull put credit spreads and 50% into calendar spreads. An event like February 5th through 9th, 2018, end of September to October of 2018, December 2nd to December 10th of 2018, and then it continued to go down. In an instant, you lost 50% of that 50% of your bull put credit spreads of your portfolio. So you 50% of your portfolio, you're down. So you just lost 25% of your total portfolio. And then on the diagonal spreads, you see 65% loss of the 50 that you're in. So you're now down about 35%. You're down a total of 60% in your portfolio because of the lie of leverage and over allocating to two leverage spread trades. That can happen. This is why bull puts only represent 10 to 15% of my portfolio, because at this day, that only dropped my portfolio down 7.5%. This here only dropped it down. It was 10%, 65, only dropped it down 6.5%. So that was a 14% loss in the portfolio. It wasn't 60. I can stomach that and move on. Now, why do I have calls in the VIX or puts on SPY? Because these things happen from time to time. The VIX skyrocketed here because of that trade war with China. The market didn't like this idea. VIX skyrocketed. The gain I made on those VIX calls covered all of the losses on the bull puts. So that might work for you, but you definitely need some kind of protection because you can drastically see the issue when you're over allocated into leverage spread trades, Stevens. I've seen this event several times, different markets. It happens. Let's go back to a 3-year chart, see if we can get that up there. Okay, so you know the dangers of doing this. Everything was fine in February. I mean, we had the warning signs that, COVID was going on, UK was shutting down, other European countries were going into lockdown, and then we started the lockdowns here and really took effect here, and we know what happened. These were events too recently. Okay, those were significant events too. Back in where I was showing you, that 2018, you can see it here. I actually cut off February. I apologize. February got cut off. That was back in here. This was that disastrous October to December of 2018. Okay, where yes, the first couple, I was not trading bull put credit spreads in this time. I had gotten out because it wasn't the time to do it based on other indicators. But this first day here in October caught everyone off guard. Here's another one in 2019, right? Yeah, May to June. I'm sorry. It's about April to May. May of 2019, big decline. Here's another one that caught investors off guard in leverage spread trades. This one wasn't as bad. It was manageable. But in 2018, you had one. This was kind of another one. 2, 3, 4. Technically 6 times there was a break that caused bull puts and calendar spreads to take significant losses, and it came out of the blue. Kind of came out of the blue. I'll talk about that in a moment. There was a few here, as you can see, in 2019. There was a couple other ones leading up to the big one in 2020. We've had a couple of other hiccups since then that caused that problem. I'm just worried, Stephen, that you could get caught. I can't tell you what allocation to use. I've just shown you what I use that works for me personally, and that doesn't mean it's going to work for everybody. But I am really, really concerned about taking all the money you have to trade options and putting 50% of it in bull put credit spreads and 50% into calendar spreads, because I've seen what can happen in sudden moments when you least expect it. Thankfully, 2 things have been working in my favor and hopefully will work in your favor as well. And that's the market sentiment tool. Now, I don't have my full account up now. This is just our webinar account. But you've seen, I can point you to other webinars on the market sentiment tool. We go back in time here. And back in January 2018, starting I think January 12th of 2018, there were 3 or 4 bearish sells in a row, followed by sell warnings. That told me the market was extended and something was on the horizon that might cause a correction. That's when I bought calls on the VIX, because thankfully the VIX was only at about 12, which we haven't seen in about 2.5 years. Well, I'm sorry, not 2.5 years. My apologies. About 1.5 years. Okay. But that's why it told me that, hey, I might want to start scaling back on my bull puts, or I may need to cover some of these positions as well. Okay. And that's what we're kind of looking for in that case, using the market sentiment. And those also came up right before October of 2018. And it did come up in April, if I'm not mistaken, of 2019. So when those sell warnings came in, and that's when I look to, if I don't already have some open, add to the puts on SPY, because they recently, the calls on VIX have been too expensive, Stephen. So I've been using puts on SPY or shares of UVXY or VXX, ETFs that you can buy that follow the volatility. Volatility is getting much lower now. It was down to 16 earlier, and it bounced back up to 17 in that case as well.